Okay, existing home sales plunge as higher rate impacts accelerate. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Today's the 23rd of March. We got one more week left, basically, in the month, and everything just keeps churning along here. I'm getting really bored of this real estate market right now. It's the same old thing, month after month, week after week. We know what's going to happen in the future. We just got to all hang in there and wait for the inevitable. But first of all, if you're not already a subscriber, if you could do me a great favor and help my channel grow and smash the subscribe button, I'd really appreciate that. Thank you very much. And just so you know, today's video is brought to you by our friends at Foreclosure.com. And Foreclosure.com, who are they? Well, they are probably the nation's leader in distressed property listings. And you can go to gethousingdata.com. Check that out. You can grab, take a look at what's going on in your neck of the woods, in your market quite easily. They got a great deal, 7-day free trial, monthly rates under $40 a month. Go to gethousingdata.com and check it out because, we talk about distressed properties, things like pre-foreclosures, foreclosure auctions, tax deed sales, probates, FSBOs, the whole bit. We talk about all those distressed property elements on this channel. You can get all that great data and take a look what's happening in your market right there. All right, guys, so existing home sales decrease or descend 6.6% in February. This is month to month. So between January and February, existing home sales decreased by 6.6%. They're still 9.1% higher than last year. This information is from NAR, National Association of Realtors, which produces their monthly existing home sales report. And I guess you could say that, we're looking at a seasonally adjusted volume of 6.22 million homes to be sold. Now, I want to be clear here. Seasonally adjusted is an extrapolation based on the current month for an annual sales total. It's not 6.2 million per month, all right? So please keep that in mind. And also the median sales price rose to $313,000, 15.8% higher from 1 year ago, with all regions posting a double-digit price gain. So there you go. So things are looking pretty busy or active. With respect to seeing price points and increases, etc. And at the end of February, housing inventory remained at a record low of just over 1 million units, down by almost 30% year over year, a record decline. Properties typically sold in 20 days, which is also a record low. So as I said, almost like every month, what are we seeing? We're just seeing new records in the housing market with respect to activity, price points, movement, timing, the whole bit. Now, despite the drop in home sales for February, which I would attribute to historically low inventory, the market is still performing pre-pandemic levels, said Lawrence Yun, NAR's chief economist. He also cautioned of a possible slowdown in growth in the coming months as higher prices and rising mortgage rates will cut into home affordability. So that's one of the main things here. So we're starting to see some of the effect of higher rates right now. It's almost like you can go week by week. So if you take a look at if rates rise, then the next week we hear that, mortgage applications decreased for the previous week, etc. So everything is very rate dependent now. Basically, home affordability is weakening. Various stimulus packages are expected, and they will indeed help, but an increase in inventory is the best way to address surging home costs. Now, with respect to stimulus packages, I don't think, we're getting some stimulus money, but it's not like, it's huge money for everybody. So I don't see how that's really going to impact home purchases. Simple as that. It's just my opinion. The best way is to increase inventory. So why are we not seeing inventory? For a couple of reasons, all right? We're not seeing inventory in the new home sales arena. Why is that? Because prices are going up, materials are going up, the cost of lumber has skyrocketed, and a basic lumber package now for a home is almost triple where it used to be a few months ago. So that's going to have an effect on price points. Couple that with rising interest rates, you're going to see lower home sales on the home sale side. Also, just the fact that people aren't moving. So, yeah, we see a lot of activity and people maybe buying second homes or leaving the city, but a lot of people have chosen to remain in place and ride out the pandemic or work from home, etc. So the normal amount of homes that would be coming on the marketplace on a normal market to buy and sell is not happening. Simple as that. And also from the distressed property side, which that's what we really focus on this channel, is that because of eviction and foreclosure moratoriums, moratoria, CDC moratoria, whatever, various state and local moratoria. Ultimately, in the end, a lot of the distressed property is not moving, and that's also holding up inventory and holding up the inevitable, which will start to happen towards the end of this year, and we'll talk about that in a second here. So that's the scoop on that. Regional breakdown. Well, Northeast home sales fell almost 12%, but still had an increase of 13% from a year ago. Median price points up to $356K, up 20% from the previous year. So when I say they're falling, it's from month to month. Midwest dropped 14.4%, still a 2.3% rise from a year ago. Median price was up to $231,800, up 14% from last February. Existing home sales in the South declined 6.1%, up 9.9% from the same time a year ago. Median price was $271,200, a 13.6% increase from a year ago. And existing home sales in the West rose 4.6% from the prior month, recording an annual rate of $1.37 million, 12% jump from the year ago. The median price was $493,300, up 20% from February last year. So the West is up, Northeast is up 20%. Can you believe that? So big time volumes with respect to, or not volumes, big time price increases. Simple as that. And they always say here, NAR, National Association of Realtors, America's largest trade organization, representing more than 1.4 million members involved in all aspects of the residential and commercial real estate industries. Now, that's if you're a realtor. Just as a side note here, you can be a real estate agent and not be a member of NAR. So a NAR, which is National Association of Realtors, that's why you're allowed to call yourself or use the realtor sort of designation. If I'm a real estate agent, I don't support NAR. I'm just a real estate agent. I don't. So just so you know that 1.4 million NAR members, but there's more than 1.4 million real estate agents across the country. Okay, just summary. I like these charts here because it's easy to see what's going on. So again, produced by NAR. You can see that the existing home sales rate, annual rate, seasonally adjusted rates dropped from what it was the previous couple of months. And again, it's extrapolated over the course of the year. So the volume of sales per that month extrapolated over a year is the seasonally adjusted rate. We're not seeing 6.2 million sales per month. Okay, please keep that in mind. We can take a look at a median price point after a little bit of a dip has increased to $313,000, which is significant. And existing home sales median price percent change year over year. So that basically is 15.8% change in price point from the previous year, which is, you can see it's about, that's the number one month over the course of the past 12 months. So there you go. If we go even farther into this, we take a look at the home sales percent change year over year. So yeah, we saw a decrease in the amount of home sales for various reasons, typically lack of inventory, but also the fact that things do slow down in the winter months. We don't see as much activity in parts of the Northeast and parts of the Midwest. So this is the Realtor Confidence Index survey. I look at this to sort of show what's happening in the marketplace. So we've got first-time home buyers dropped by a point from last year. Sales to investors remain the same. Cash sales increased from a year ago. Distressed sales, which we always point out, only 1% of all the sales across the board are distressed sales, which are made up of short sales and foreclosed REOs, which is real estate owned, bank owned properties. Days in the market, so we see a significant decrease from 20 days on market as opposed to 36 days on market. So property is moving basically off the shelves. This is what they say. All right, guys, keep going here. Existing home sales by region: the South with the most, 45%, the West 22%, the Midwest 21%, the North 12%, accounting for all sales across the board there. Housing supply at the obviously national level, you got national month supply in the blue line, single family, the red line, condo, co-ops, the green line. We're basically running a little over two months worth of supply on a blended level here. All right, to put things in perspective, the supply means that, and how we look at these months. So we always say that 6 months supply is a balanced market. But what that means is if no new sales or new listings came on the market starting today, it would take, in this case, a little over 2 months for all the homes to be sold, and we'd have nothing left to sell or to buy. So that's where this housing supply is. That's how it's calculated. Sales by price range, you can see where the sweet spot is. The 250 to 500K is the sweet spot for housing, and 100K to 250K, the next level down. We are seeing increases in the, I'll call it the upper tiers, so the 500 and above, 750 and above, and a million above. Every month, it seems that those segments are increasing in their sales volume, which, if you take a look at the percent change in sales from a year ago, so we're actually, the lower 0 to 100K range is losing a quarter of its sales. The 100 to 250K is losing almost 11% of its sales, whereas 250 and above gained a little bit, and then 500 to 750 is 50%, 750 to a million is 66%, and a million plus is 81%. So you can see that on the higher priced homes, there's a lot more activity. So what does this mean? Well, does it mean that people with money are going, I want to buy homes, I'm going to buy second or vacation properties, which may cost more. I'm buying bigger homes for our needs. So who knows? It's a mix. And again, the more of those homes that are sold at higher price points probably does skew the median sales price a little bit as well too. And here's the seasonally adjusted supply. So if you take a look at this chart, starting from January 2020, which the month supply was 3.5 months, to where we are in February at the bottom. So we've lost 1.5 months pretty much worth of supply over the course of the year. So there's nothing there. Locations around the country have less than 1 month's supply, believe it or not. Where I live, we have less than 1 month. So we have like 0.09 months worth of supply in our area, which is actually kind of ridiculous right now. So talk about this. This is from Zero Hedge. Clearly you can see the big shifts. We're kind of back where the seasonally adjusted pace was a few months ago. And, I guess you could say that the expectation was a drop, but the drop, I guess, we'll say plunged as opposed to tumbled. So I guess if you want to use words to describe things, existing home sales rebounded, but we're expected to rebound in January, but we're expected to slide in February as interest rates rose against expectations of a 3% decline. Existing home sales plunged 6.6% month over month. So there you go. So that's where we get some of this change here. Now, NAR blames supply, of course, the fact that even with the decline in sales, days on market is swift, prices are rising strongly. It's implying that demand isn't disappearing from the marketplace. It's really a lack of supply. Well, if it's a lack of supply, then we have to take a look and address the reasons why we have that. And part of that is the government from holding up a lot of the foreclosures and evictions and things. Part of that is forbearance. So there's reasons why stuff's happening. A lot of foreclosure properties aren't being processed, that maybe don't even fall into the forbearance realm. So stuff that could be happening to help with some of the inventory is not allowed to happen, and that will affect things as time goes on. And what they also mentioned here, well, actually, I'll talk about that in a second. This actually came out from the American Enterprise Institute. Is talking about house finance, the insights, the new normal. So in the recent weeks, the 3 loan purpose types have responded differently to increasing loan rates. As of today's level of 3.25%, purchase volume will continue to be strong as purchase volume is relatively inelastic to rate hikes. However, no cash out refis are already seeing large volume declines. So when rates go up, people aren't going to refi as much. And because there's fewer loans that are in the money. So in other words, everything is based on a calculation. The higher the rate, the less you can take out and the more it's going to cost you, etc. Cash outs are down modestly, not as much as the non-cash outs, as these borrowers are driven more by a cash out need to refinance as opposed to rate. So if you got to take cash out of your property, you got to do some equity stripping, it's going to happen at whatever cost you can bear. Now, really realize this, that it's not like I'm talking about 8 or 9% rates here. If you're still in the 3s, it's still historically low rates that are going on. So it's not that bad. But compared to the previous few weeks when we were in the 2s, then yeah, maybe things are a little different. So again, this decreased buying power is already having a limited impact and slowing of the home price appreciation. So the somewhat lower home price appreciation in week 10 of 2021 looks like the first sign of this trend. But they also added, a loan rate of 4% might, due to severe supply constraints, still result in an unsustainable rate of 8 to 11% as time goes on. Mortgage applications for the purchase of a home have also declined from the peak in mid-January. So when we had the lowest rates, things were peaking. Now things have changed. It's slowing down a little bit across the board. So let's take a look at the next slide here, which I found interesting. So it's their purchase rate lock trends in submarkets, which second and vacation home markets continued to boom, as evidenced by 2 trends, which is really interesting here. The share of second home rate locks is at a series high, and volume in zip codes with 20% or more vacation home share continues to grow at a much faster rate than the rest of the market since the pandemic. So what does that mean? Well, it looks like people are going, you know what? I want a place to go. I want a place to bug out to. Maybe, I'm not going to sell my property right now where I'm at, where I currently live, but I want that flexibility to move or to relocate or to bug out in the future. So we're seeing the secondary homes are becoming more popular, and they're purchasing those right now. We expect these trends to continue for the foreseeable future as households seek warmer climates, more space, and less crowded areas. So that's why we're going to see towards the south and maybe toward the southwest a lot more activity, because people are going, I don't need to deal with the northeast or Midwest or North Midwest issues of snow and cold and unpredictable weather. They're going to come down here. And also, there's more room, right? Leave the more densely populated northern states and coming down to less population or more land or what's not quite developed yet. So we're seeing a lot of that happening in Florida down here, Alabama, Georgia, South Carolina growing, Texas growing, New Mexico growing, places like that. So we're going to see a change or shifting of where people want to go. But it's cool because maybe they don't want to quite sell their property yet and cash out from their main property, but they're going to buy something as a secondary option, which is very interesting. All right, if we take a look at this, another part of the submarkets, which I found was unique, is submarkets related to investor loans, non-U.S. citizens, and the self-employed are similarly active. All are at near series high in terms of purchase rate lock share. What that basically means is these loan series, these type of loans, are at highs as far as activity is concerned. And when they say the word rate lock, my assumption is that you're into the mortgage process, you've got a contract on a property, you're working towards a closing of that transaction, and then you lock your rate in. So I got this great rate now, I'm going to lock my rate in so I know it's a guaranteed rate. I get to closing regardless whether the market goes up or down. All right, so that's what people are doing. They're locking their rate, especially if they feel that we're going to see some rate increases on mortgage rates and interest rates, etc. So people are locking their rates, and they know they can basically close at a predetermined amount. But funny, of course, the investor market's growing. A lot of people are doing investor homes and rentals as investors, and there's a lot of financing available for that. Self-employed, so these are people that don't fit into that qualified mortgage box. So they're going, hey, I'm going to take advantage of these rates right now too and get into the game. Also, non-U.S. citizens. So why not, right? If you're here on a green card, a work visa, or something else, people are buying properties because they think it's a great opportunity or they want to be here or whatever reason they have. But that's what we're seeing right now. So it's like all areas, all segments of the markets are experiencing a lot of activity from the mortgage perspective, even though it does ebb and flow with rates. So it seems from this weekly data that the housing market remains red hot, but the higher mortgage rates, which remain ultra low by historical measures, have already started dialing down the heat. So again, if we take a look at their HPA, their house home price appreciation, it actually has dropped a little bit, and we'll see if that trend continues. So ultimately, in the end, when will this ride end? Well, it can't go on for much longer. This market cannot be sustained. So we're probably seeing some of the testing now of the marketplace with higher rates and see how it's all going to play out. So we'll see what happens. But in the end, I look at this going, this is just the beginning. I haven't seen the most recent Black Knight financial on delinquent loans. This is January's number. We should be getting February's number anytime right now because we're getting towards the end of March. 3.3 million people, according to Black Knight, are delinquent or in the foreclosure process. Those people who are delinquent, if they're in forbearance, they're included in that number as well too. As I always say, that number is what? It's not an accurate number. Why? Because when I look out there, we get conflicting statistics. The actual number is much larger as far as I'm concerned. When I do my analysis and talk to a lot of people who I know in the industry who have access to data, they go, this is not right. I do believe that Black Knight, no knocks against them, but as a data provider over the years, I've always noticed them being different than other data providers or data analysis companies. They've always had lower numbers or been more conservative. Who knows? And realize that this is not absolute numbers. This isn't pay count. This is extrapolation and sampling coming up with some numbers here. So it's got to have a lot of room for, I guess you could say, just for some differentiation for sure. So you need to keep that in mind. That's why I believe the number is much, much bigger, and we're also not being told because of the narrative here. Going back to the uncounted, the need for further research, it just boils down to that we go with the housing equity narrative, all right? Well, one strength of the current housing market is that on average, homeowners have considerable amount of equity, and home prices in most parts of the country are still rising. But long forbearance can erode equity, and foreclosure can negatively impact neighborhood housing values. So that's right. So you think you have all this equity in your house. Well, when you add what you've missed in your payments, that equity sort of drops down a little bit. And then when more and more distressed properties come on the market as it's time to sell, guess what? That will drop prices. So you've got a couple of factors that no one's really considering when all the housing hack hype people are saying, oh, everybody's just going to walk away and sell their homes because they get all this equity. That's not going to happen. That can't happen. And also, where are you going to go? Okay, if you have income issues, where are you going to go? That's why people are going to hang on till the bitter end, and it's going to cause them problems, with their equity. So, short sales, other pre-foreclosures sales are poised to become more dominant share of the distressed market in 2021. Well, this has been spoken about for the past few months, and it's going to happen. This just came out here. Pre-foreclosure sales set to dominate distressed home market. Well, you take a look at this chart. This is information from Adam again, adamorauction.com. And, when we go and take a look at sort of where this happened, where it starts back in the last housing crisis, and you see where things are at, well, it's pretty interesting to notice that, well, back in 2005, we didn't have many short sales, pre-foreclosure sales. We had lots of foreclosure auction sales. That's actually kind of remained pretty much constant, but we've seen REOs, that's the orange, the real estate owned segment, okay, increase dramatically because banks are taking properties back and selling them as REOs. Well, as time goes on, there's less and less of those REOs, but what people realize that let's get to these properties before they go to auction, before they become REOs, because we have a better chance of getting our hands on them because we're dealing with the homeowner, not institutions. So we take a look at, from trending here, from 2005, it's kind of, sort of been on a slow, I guess you could say, growth on the blue side, pre-foreclosure sales. Now, pre-foreclosure sales, are sort of ambiguous here. What those are going to be are you sell before you go to foreclosure. Maybe it's a discount or a quick sale, or it's a short sale. So we can see that, as time goes on, 2009, 10, 11, slowly increasing, kind of plateauing, kind of increasing again, to 2019, where 33% of distressed home dispositions were pre-foreclosure sales. The 49% for 2020, that is actually I believe that's a prediction because they haven't got all the numbers in yet. So they're saying, I guess they're trending and seeing much larger. So that bodes well for those of people who need or want to learn short sales. It's more accepted. It's more happening. Short sales are going to be in that mix as well too. We're going to see a lot more of those towards the end of this year and next year as well. Remember, numbers are out there, guys. Other data providers are talking about 3 million plus foreclosed homes over the 2021 to 2025. Okay, that's foreclosed, like going to auction and getting foreclosed on. What about the pre-auction stuff in the short sale? So is that included? We're not too sure. So there's going to be enough out there. It's going to change some stuff in the marketplace, and if the numbers are underrepresented, we're going to have some stuff happening in the future. So remember, 1% of all on-market property sales fall into the distressed property category. These are REOs and short sales. No one's doing short sales. How do we know this? We'll go back to that 1% rule because, again, the 1% there, distressed sales. So distressed sales are short sales and foreclosed homes being sold as bank-owned REOs. So if 1% of all the sales across the U.S. on a monthly basis are distressed, let's just go half for short sales and half for REOs. So that's 0.5% for short sales. So no one's doing them, and that's the big opportunity. It's going to happen in the next little while. Foreclosure filings are quietly increasing. I track this quite regularly, and I just sent out a bunch of marketing, and I'm starting to go back into the field and do stuff like this now. More properties are scheduled for foreclosure auction. Again, think of the 1% rule. Those are potential opportunities there. If no one jumps on them, they're going to go back to the lender, or they're going to be sold at auction to the big cash buyers, and then it'll beat us to the punch here. What is the next opportunity? More distressed properties. They will come. All right. Owners will need to sell. It's time versus dollars. The longer they wait, the less equity they have, and it's going to hurt them in the end. Investors will liquidate. Some of them who maybe you've had tenants and who haven't paid you for over a year right now. So how many investors are well, and I call them, investor, I'm talking the smaller segment, the ma and pa, the onesie twosie investors, the sub 10 owners of homes, 10 units type of thing. If how much reserves do you have? Can you carry a mortgage? Because realize that a lot of these mom and pop investor owners do not get the benefit of forbearance because they're not primary homeowners, all right? And so if your renters aren't paying you, but you still have to pay a mortgage and insurance and taxes and upkeep and things like that, there comes a point in time where you're just going to go, I can't do this anymore. You're going to unload that as well too. We will see uptick in foreclosure auctions because when things open up, and they're starting to, all the properties that were in process that are stopped will start up again. That's your next uptick. We're going to see uptick in foreclosure filings. We'll see upticks in more short sales listed. Eventually, we'll see an increase in REOs as the distress moves through. More will be available than predicted. We are not seeing the true numbers. Mark my words here, guys. All right. So that's kind of the scoop on all this. So, of course, what I do, I have training and information. So I've got something new called Zombie Foreclosure Flip, which I'm announcing right now. It's more of an entry level for people who don't want to get into the short sale business right away. This covers all the distressed property and the retail buying side as well too. Basically, how to buy stuff cheap and how to save money on real estate transactions. Inquire if you want more information on this. I'll give you an example. This is my market where I happen to live. It's the Tampa, St. Petersburg, Clearwater MSA. This is based on January numbers because February's numbers for the MSA is not out yet. You can take a look at the red arrow. Our volume or our inventory is less than 1%, which is nothing. Okay, we've got nothing to sell here or nothing to buy. And when you take a look compared to the median price points in January, we'll look at the median sales price was $285,000, and foreclosures REOs sold for $180,000. That's a big discount there, and short sales sold for $194,500. So now, granted, the amount is small. So the samples of REOs and short sales are small. Well, that's not even a sample. That's the actual numbers that were sold. So when you got 3,300 sales in the MSA in 1 month, and basically 52 of them are distressed properties, that's nothing in the overall. It's 1% or just over 1% of the entire marketplace here. But you take a look at short sales. I mean, it's a 32% discount over retail, $90K in equity when you compare median price points. Now, sure, different properties are going to have different values based on the condition, stuff like that. But my point is that at a basic, simplistic, numeric level, you can see that there's equity there and there's opportunity there. So, and I can tell you that this type of stuff, people aren't even pushing these values down because I know that a lot of these are just retail short sale processes, and the listing agents probably haven't worked hard because they don't feel they have to or want to or even know how to push values down for their clients. Well, and actually the buyers aren't even their clients in most cases anyway. So we know how to do that when I work my system, etc. We can get those numbers down even greater. So our discounts there, people always ask me, Randy, what type of discount can you get in a short sale? Well, here's a discount. You're looking at a 32% discount here on a retail short sale level, let alone an investor style one, which we can push even farther. So stuff will be available. Discounts will be there. Need to get into the game, all right? That just proves that there's opportunity right here. I'll tell you about it. Just connect with me. There's my email address. So once again, guys, thanks for all the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. I'll look forward to speaking with you later on in the week. So take care, and we will talk to you soon.